What's going on social media? Today we're going to talk about the shrinking ice cube when dividend kills your portfolio. Now, if you didn't know this, I'm a very big dividend investor. I believe in dividend, and I do have a dividend portfolio that I'm building up for my bridge account. So I spent an ungodly amount of time research and studying about dividends. Now, here's the thing. I fell for some of these traps, and I'm trying to help you understand dividend investment so that you do not fall for the same trap that I did. Now, the chasing high yield dividend stock, the phenomenon is called shrinking ice cube. Here's the thing, high dividend is often not a sign of a healthy company, but rather a warning sign that the stock price has crashed due to poor business performance. So that's the definition of it. So here's the key takeaway that you need to understand about in this video. The first thing you need to understand is the high yield trap. Dividend yield is calculated by dividing the annual dividend by the share price. If the yield is unusually high, it usually means the stock prices has fallen significantly, reflecting market lack of faith in the company. So that's the issue with it. High yield could be a trap, could not be, and this is why you need to do due diligence. And the other issue you have is called a double whammy. When a struggling company finally cuts its dividend, you lose the dividend payout and often the stock price plummet. So you get hit with both of them. Now, in some instant it doesn't, in other it does, but that's the deal with it. Institutional investors will exit their position if they're in there for the dividend and will be cut out. So I am trying to help you understand this. Don't get trapped into this because what happened is your dividend is going to be flatlining and then all of a sudden it's going to tank, lose 20-30%, and you're not going to get paid a dividend anymore. So those are the things you need to watch out for whenever you're buying a dividend. And that's why it's called shrinking ice cube. It looks good, but slowly eating away your portfolio. Now, here's some critical metrics that you need to understand. The payout ratio. Avoid companies that pay out consistently above 80%. This doesn't seem like a good deal for you. You could fall for traps, and here is one of them that if they're paying 80% or more, you really need to do your due diligence to make sure you don't get yourself in a bad situation. The other thing you need to look out for is the free cash flow. Always check if the company actually has the cash to pay the dividend rather than just relying on reports and earning. This is why the financial statement is very important. You got to pay attention on every single company because at the end of the day, if you're not looking at the free cash flow, how are they going to pay your dividend? How are they going to deal with growth of the company? If they don't have cash, they're broke. They could be called bankruptcy, and you're in a bigger problem. Now, let's talk about the reality of REIT and EOC. Now, if you don't know what REIT is, I'm put the definition on the screen. And if you don't know what EDC is, I'm put that definition on the screen. So we can be on the same thing. Now, these structures often offer high yield and returns. Now, the issue with it, they have a high leverage. And this is where if a particular market get hit with a bad year, the vulnerability during an economic downturn. So if the downturn is going to be bad in that market, like in real estate, you are going to get hit dramatically because they're highly leveraged. Now, here's 4 steps that you need to evaluate the stock if you're worried about the dividends. Number one is the red flag trigger any yield over 5%. That is a red flag. And this is where you got to do your research. How are they able to pay that 5%? Do your due diligence, do your research. Because if they're paying more than 5%, it raises a lot of flags. So make sure you do diligent. They can afford it, have free cash flow, and they're in a position that they can do it. Not all of them are bad, but if they're paying 5%, I would tell you that's a red flag. The second thing is ratio check. If you don't know what a ratio check is, it's just to see how much dividend, earning, cash flow are doing. So ensure the payout ratio are under 70%. That is a red flag. It's above 70%. And if you see one, you say, oh, this is a great stock, 70% and above, I will tell you to do your due diligence and double check why you want to buy that stock. Now, the third thing is growth history. Now, look for the constant dividend growth to ensure that you're buying a good stock. Now, here's the thing. Flatline or shrinking dividends are a warning sign. If the dividend is on a decline because of structure issue or XYZ that they're doing, that's a risk sign. They might be cutting dividends soon. Also, if their growth is a flat line and they're paying a 3% dividend and they have a 5% growth in 3 years, they have a 10% growth in 10 years. At the end of the day, you're not going to get as good a return if you pick another stock. So at the end of the day, that is a red flag. Make sure you pay attention to the growth history. Now, it doesn't tell you what's going to do in the future, but it is a good indicator to check on how well the company's been doing. And the last thing is total returns. Review the stock 5 and 10-year initial return to see if the company's actually growing in value. And if they're not growing in value above the S&P, I don't recommend you buying them, because why not just buy the S&P at that point? So my bare minimum for any of my stock is they have to outperform the S&P. But that's up to you. You might find something that is going to go to the moon. So at the end of the day, just do your due diligence and understand, don't buy stocks that have a good dividend and they end up having a negative growth. Because at the end of the day, you're losing money in your portfolio. Like and subscribe to my video. That's all I got for you.